It's shocking. Most people who trade straddles don't make money, even when markets are volatile. Why, you ask? It comes down to just three simple factors that are often overlooked by traders. And once you know them, you'll be a better trader in all situations, especially when expecting high volatility. See, straddles are simple, at least they are on the surface. If you're expecting a big move, but you're not sure of the direction, well, that's what straddles are for. Buy a call and a put with the same expiration and strike. If the stock goes up, calls make more than the puts lose. If the stock goes down, the puts make more than the calls lose. Win-win, brilliant. But here's the rub. There are three things you need to know about straddles before making a trade. Number one, you are not the only person looking at the market. I know, it's shocking, right? No. Right now, there are literally millions of people looking at every stock that trades. They read what you read. They use the same analysis you use. The wisdom of crowds theory states that there's a good chance they have pretty similar thoughts about that same stock as you do. And some of them beat you to the punch. You can bet your last dollar some traders bought that straddle you're looking at before you. And there are others who just bought the puts as a hedge or bought the calls as a spec. The buying is in. The demand has already begun to drive the prices of those options higher. This is the effect of implied volatility. If you think of the value of a straddle, that's value in the classic sense, meaning usefulness, being that you can make money if you see the volatility you expect, you'll pay for that value. And just like anything else that has value, at some point the price can be so high, it's no longer worth it. That being said, here's the second thing you need to know. Number two, there ain't nothing in this world for free. With a straddle, you're buying the benefit of being able to make money whether the stock goes up or down. But it's not really the total cost you pay for the straddle that's the most important factor. You can sell the straddle later, so the price isn't really the cost. The true cost is more like the daily rent for having this benefit. Theta. All options lose value as time passes. That's called time decay, and it's measured by one of the metrics we use to make smart option trading decisions, the option Greeks. The option Greek that matters here is theta. Every day the stock doesn't move enough, you lose a little bit on this asset, and it's a fair trade-off. After all, you're betting on increased volatility. The bet is, if you get volatility, you make money. If you don't, you lose money. But when demand is high for the straddle, the total cost of the straddle is higher. That also means theta is higher. It's running against the wind a bit. But still, if you get enough volatility, you can still win. That, however, is complicated by our final thing to know about trading straddles. Number three, the wind gets stronger. We have to get into the weeds a little bit here, but here we go. As shown, when implied volatility rises, theta rises. But there's a second order Greek here called gamma that's important. In a nutshell, gamma in this case is how much money you make on your straddle given a unit move in the stock. When gamma's high, if the stock moves up or down, say 1%, you make more than when gamma is low. Sometimes a lot more. Many traders don't look at this, but this actually determines whether you make money or not. It's the most important factor of all. But here's the thing. When implied volatility rises, not only does theta get bigger, but gamma gets smaller. This is what I like to refer to as the double whammy. It's sort of like running against the wind with ankle weights on. Knowing these three key factors is a game changer when it comes to trading straddles. This will help you select better trades, avoid trading the bad ones, and set better expectations to pick better straddle candidates. If you want to make straddle trading work, the first thing to look at is that implied volatility number. If it's too high, the straddle might be priced out, making the prospect of a winning trade too much of a challenge. But here's a little trick. Look back at where the stock traded in recent past to get a feel of how far the stock might reasonably move. Then look at the price of the straddle at a strike price that distance away from your strike price. This is what I call the gamma hack, and it's a great estimation for how much you would make given a reasonable expectation for volatility. Then you can easily decide if the trade is worth the risk. For example, imagine you're looking at the $230 straddle priced at $9.25. The recent trading range shows an $8 move is reasonable over the next couple of days. Here's what you do. Look at the prices of the $222 straddle and the $238 straddle. Note, these are both $8 away from your strike price. Those straddle prices, $8 away, are a great estimate for what your straddle would be worth if the stock indeed moves $8. If the profit is enough to balance the risk of the stock not moving enough and therefore losing from theta, you can feel good about taking the trade. But remember, as time passes, theta works against the trade. So you'll have to repeat this process and use the new numbers with the new straddle price every day as it becomes lower by theta. If after a few days the trade has yet to show a profit, it's a good time to exit and move on to the next better opportunity and another chance to bring in some profits. I'm Dan Passarelli. Trade well.